You hear metal clinking in the dark, like the heartbeat of an age changing its blood. Every time money weakens, something old rises out of humanity's collective memory like a primal reflex. Gold. Not because it's mystical, but because it tends to be the last thing that doesn't move when everything else is slipping. History isn't random here. Before gold moves to the foreground, the world walks the same 7 steps. 7 stages that repeat long enough to feel like a cycle. Stage 1 is the age of easy trust. Money is backed by discipline, by rules people actually follow, by real productivity. Governments promise little and deliver quietly. Markets aren't scared, so rates stay low as a reward for consistency. In this calm, gold is jewelry and museum decor noticed, not needed. Yet beneath the gloss of prosperity, a small pull begins a quiet drag, not enough to trigger alarms, but enough to bend the path ahead. Stage 2 is the era of overreach. Empires add bases, states add programs, companies add projections. Each move carries a respectable reason. All those reasons borrow a little from tomorrow. Cost stack. Commitments weave into a cable across a bridge that's beginning to rust. Gold still stands motionless. That stillness is a rude mirror in a world sprinting ahead. Stage 3 is when deficits become structural. Shortfalls stop being accidents and harden into habit. Budgets are written around what should happen, not what must be survived. Debt swells like an hourglass flipped upside down, sand from the future falling into the present. Rates can remain low because markets tell themselves they'll figure it out. But trust, borrowed long enough, changes smell. Gold stirs, slowly, quietly, a shape in the dark, changing posture. Stage 4 is debasement. When revenue won't rise and spending can't be cut, the softest tool turns out to be the sharpest. Change the nature of money. In Rome, it meant diluting the denarius. In the age of silver empires, it meant flooding the system with new metal natural QE. In the 20th century, it meant removing the gold anchor and letting money become a pure promise. Result: the measuring stick itself shrinks. A meter stops being a meter. A unit of currency stops meaning what it meant. Gold doesn't have to sprint. It simply refuses to change nature. Because it does not change, everything else must be remeasured against it. Stage 5 is inflation breathing in your face. Not just CPI on a page, but lunch prices, rent, power bills, and borrowing costs. When asset prices run first, people feel rich. When the grocery basket catches up, people feel exhausted. Companies raise prices to save margins. Workers demand wages to save dinner. Banks demand higher rates to save balance sheets. A snake eats its tail. Gold ceases to be antique and becomes a confidence gauge. Every uptick says, I trust your purchasing power, promise a bit less. Stage 6 is the break in confidence. Capital votes with its feet. Long bonds demand a risk premium. Stronger foreign currencies get chased. Gold walks from the edges to center stage. Money exits countries with the weakest promises and flows toward the heaviest silence. Central banks that called gold a non-yielding relic for decades quietly buy it like students who finally took the hard class. Households in fragile economies hoard small bars and coins like bank accounts that don't require passwords. The jeweler becomes the everyday branch of last resort. Stage 7 is the reset. Not always collapse, sometimes a rule rewrite. New currency frameworks, new anchors for trust. But before a new anchor earns belief, the world needs a temporary weight that does not lie. For millennia, that weight has been gold. You could say this is romantic. It isn't. The myth survives because it explains something practical. Systems need a negative feedback loop when they get too generous with themselves. Gold plays that role. When monetary discipline relaxes, gold embarrasses the numbers. When narratives outrun data, gold ends the play with a price nobody scripted. It isn't partisan. It's a mirror. Look at that mirror through real seasons. Spain drowned in silver. Prices rose first. Noble pride refused to let production grow. Gold and silver flowed in. Dignity and competitiveness flowed out. Smart observers didn't mock silver. They learned that precious metals are a tailwind only when the sail is productivity. With a torn sail, more wind spins the boat. Britain tried to preserve honor with a pre-war gold parity. A beautiful number placed on a weakened body. The price was private sector strangulation. Only by abandoning an unsustainable beauty could healing begin. That's the bill for monetary aesthetics. Never confuse a pretty exchange rate with fiscal virtue. The Soviet Union had commands instead of prices. When prices don't speak, goods speak by disappearing. The ruble was a sealed promise, trapped inside borders, with no exchange valve. Oil was the oxygen tank. When oil prices fell, the tank emptied, and the public's patience emptied with it. For ordinary people then, gold wasn't speculation. It was quiet rescue. Gold, however, is not magic. It doesn't make a country rich. It preserves what sweat already created. So in stage 1, when trust is abundant, don't hoard gold like a faith. In stage 5, when inflation bites dinner, don't sneer at savers who hold it. Gold doesn't need your belief. It requires your sobriety. You want a simple check to see where you are on the staircase. Build a 7-gauge dashboard for yourself and the nation you watch. Is the structural deficit shrinking when growth is positive? Are interest expenses rising faster than revenue? Is the current account deeply negative? How high is foreign currency debt relative to foreign currency income? Is average debt maturity shortening? Is labor productivity growth lagging wage inflation? Are 12 to 24-month inflation expectations stubbornly above target? 4 red lights mean cheap time has ended. When time is expensive, gold is cheaper than it looks, not in price, in function. Old hands listen for gold's footsteps using a few ratios. Dow Gold, how many stock index units per ounce, tells you the market's bid for story versus staying power. When stories are fat, the ratio swells. When durability speaks, it contracts. Gold oil ounces per barrel whispers about the economy's electrothermal tension. Expensive energy with cheap gold can signal recession fear. Cheap energy with expensive gold points to monetary distrust. Real yields are the anti-gold when they're negative. Yielding assets often erode purchasing power, making a yield-less asset relatively attractive. Don't preach, measure. Don't ignore market plumbing either. Gold comes in 2 layers, metal and paper. Metal moves slowly but endures. Paper moves quickly but panics. You want both because they serve different jobs. Metal for power outage, network down, trust down scenarios. Paper for volatility, rebalancing, and tactical opportunity. Just don't to let paper replace metal completely, and don't let metal become a logistical burden that steals your sleep. A quiet protagonist in this story is the central bank. For years, many sold gold. Then they stopped, then they bought. Not out of romance, but because they know the cost of rules with exceptions. Every time a big economy bends its framework, somewhere a reserve manager adds a ton. That's the profession's way of saying, sometimes the referee gets tired. Players must protect themselves. At the household level, the logic is smaller but identical. You don't hold gold to get rich. You hold it so someone else's mistake doesn't make you poor. When real rates are solidly positive, income's reliable, and policy steady, shrink your gold and grow your productive assets. When real rates go negative, jobs wobble, and rules change faster than seasons, increase the time buffer of gold. The days you can breathe if the oxygen line kinks. For businesses, gold is a lesson in matching terms and currencies. Don't sell in local currency and borrow in foreign currency because the rate seems cheaper. When gold rises, FX often rises too, and you pay twice. Don't fund a 10-year asset with 18-month money because your lender likes you. When the window shuts, you'll pay with equity, payroll, and reputation. Gold's real lesson is respect for unchanging things. Long assets require long funding. Resilience is never an accident.
For nations, gold is an institutional ethics test, not moralizing on stages, but morality with numbers. Will you publish a 12-quarter redemption calendar and keep it, rain or shine? Will you let the exchange rate reflect reality instead of pinning it for a pretty speech? Will you say no to negative and PV projects that trend on TV? When the answer is yes, gold becomes a museum piece. When the answer is no, gold becomes a siren. Why does attention swing to gold in a crisis instead of technology, education, or reform? Because those are engines, propellers, and maps the true drivers. But when a plane hits brutal turbulence, the first thing a pilot does is drop the landing gear and fly by the simplest instruments. gold is landing gear. It won't lift you higher. It helps you not fall. Because it's landing gear, you need discipline not to deploy it at every shudder. Fear is good fuel for vigilance and terrible fuel for portfolios. Choose a gold allocation 5%, 10%, 15% of net worth based on how you earn, job risk, where you live, and access to foreign currency. Set a rebalancing rule. Trim when price pushes the weight above target. Add when calm drifts it below. Remember, gold pays no dividend. Its dividend is calm. Calm has a price. A frequent mistake is treating gold's rise as the period at the end of history. It's usually a comma. Every cycle has a rebuild phase. In reconstruction, gold retreats from the front page. That's when you pour capital back into productivity, businesses, infrastructure, and education. Gold won't be offended. It's a gatekeeper. When you behave, it stays quiet. When you slip, it rings a bell. Walk the stages again. This time with signals anyone can see. In stage 1, your country enjoys steady, positive real rate differentials versus G7 peers. Debt to GDP is flat or falling while growth is positive. The yield curve is normal, not bent by desperate interventions. Talking about gold gets you polite smirks. Contempt is the sound of calm. In stage 2, the public balance sheet accumulates guarantees, off-budget funds, temporary programs. Taxes fall while spending rises to stimulate. The yield curve flattens a touch. Gold doesn't surge, but stops fading. Gold is obsolete, fades from op-eds. You can keep a bit, creeps in. In stage 3, the budget adds a fast-growing interest expense line. Bond auctions begin to sputter. Politicians repeat the word flexibility. Gold becomes more reactive to bad news than good. Not because it loves fear, but because it's a weather alarm. In stage 4, you hear modernized policy frameworks, new operating regimes, and optimized structures. Money changes names, rules change wording. The truth is the same. The old standard can't bear the current weight. Gold jumps in stair-steps. Each step a public promise paired with a private admission. In stage 5, trust moves house from banks to safes, from long bonds to hard assets, from durably positive real rates to someday. Gold enters family conversations. When people ask where to buy more often than why, the cycle is deep. In stage 6, rumors replace press releases. Capital controls administered prices. Rationed allocation. Physical gold trades at a premium to paper. Some sell gold to live. Some sell homes to buy it. This is the loudest dark dirt. Your discipline matters most now. You set your rules in peace so you can follow them in storm. In stage 7, new laws, new standards, new words arrive. A fresher generation unscarred by discipline learns to love it. Gold recedes. Prices may stay high for a while from fear's inertia, but its star roll dims. That's your cue to lighten the weight and redirect into productive uses again. You thank the gatekeeper by not abusing him. Throughout, keep one non-negotiable. Don't use leverage to buy peace. Borrowing to buy gold turns the seatbelt into a razor. If you need debt to hold gold, hold cash instead. Peace is never purchased with numbers that steal your sleep. One more reminder for newer investors. Gold miners are not gold. One is indifferent metal. The other is a business with operating, political, environmental, and financing risk. Sometimes they rhyme. Often they don't. Use miners to amplify the cycle only if you already have metal and cash as the cushion. Don't reverse the order. Remember taxes and law. Some places levy progressive taxes on gains. Some restrict forms of ownership. Some add heavy transaction fees. The cheapest calm is the legal kind. Prepare the official route before shortcuts close, and never let gold be an excuse to postpone discipline. No bar replaces a productivity strategy. No handful of coins rescues an unbought product. No ingot builds institutional trust where promises are broken. Gold only buys time use, that time to repair. One day, the cycle will reset to stage 1. Maybe you'll chuckle at gold accumulators as quaint. Maybe others will chuckle at you for holding too long. Either way, discipline doesn't need applause. It needs a role. You don't have to prove anything to anyone. You only need to keep the one thing that matters most: autonomy in the face of volatility. If you're crafting this as a video, close with a simple image, a meter sealed back to exactly 1 meter. A currency that knows how to be modest about debt. A compass finding north again. Beside them, a silent metal bar, no judgment, no sales pitch standing there as it always has. When money weakens, gold doesn't ascend to rule. It steps forward to remind. It reminds that value is a habit, not a slogan. That promises can't be printed, only kept. That wealth is not breathless numbers, but foundations that breathe evenly. And that when you want to shout in a storm, you should instead fasten the belt, check the gauges, and do the thing you practiced. 7 stages don't have to end in ruins. They can end in maturity. Gold will step back, the cycle will move on, and you, if you walk through, it will stop asking, is gold going up? And start asking, what did I build with the golden time it bought me? That is the only question worth answering.